In the Forex market, when you see something like the Australian dollar versus USD, the USD versus the Japanese yen, the British pound versus the USD, or the euro versus the USD, all are examples of a currency pair. In the euro-USD pair, the euro is known as the base currency and the USD as the code currency. Most Forex pairs have 1 pip equal to 0.0001 or the 4th decimal place. This change of 1 pip is the smallest change in the price of a currency pair. Only in the case of USD versus the Japanese yen, we have an exception where 1 pip is equal to 0.01 or the 2nd decimal place. When you see a Forex rate such as Euro-USD equals 1.1330, all this means is that you can buy $1.1330 with 1 euro. Let's say the Euro-USD increases by 1 pip from 1.1330 to 1.1331. This means that the euro has strengthened as compared to the US dollar, as now 1 euro can buy more US dollars. On the other hand, if the Euro-USD decreases by 1 pip from 1.1330 to 1.1329, this means that the euro has weakened as compared to the US dollar, as now 1 euro is able to buy less US dollars. A lot is a unit of volume used in the Forex market. Just like in the stock market we trade in shares, the same way in the Forex market we trade in lots. We classify lots in different trade sizes. The standard lot is equal to 1 lot or 100,000 trade units. For example, if you buy 1 lot of Euro-USD, this means you're buying 100,000 euros. The same way, a mini lot equals 0.1 lot or 10,000 trade units, and micro lot equals 0.01 lot or 1,000 trade units. Let's say you trade 1 lot of Euro-USD, you would make or lose $10 for every pip it moves up or down. Same way for 0.1 lot, you would profit or loss $1 per pip movement. And for 0.01 lot, it's $0.1 for every pip. One of the most important equations in the Forex market is the profit and loss equation. Let's break down the variables. Q is the total profit or loss we want to calculate. P sub B is the buying price. P sub S is the selling price. T is the standard lot size or 100,000 for Forex pairs. And L is the number of lots we have traded. Let's do an example of the Euro-USD. We buy 1 lot of Euro-USD at 1.13820 and sell it at 1.13920, and we want to calculate the total profit or loss. Let's plug in all the values for the variables. So 100,000, our standard lot, multiplied by 1 lot, our lot size, all multiplied by the difference in the buying and selling price, which is 1.13920 minus 1.13820. And we get a total profit of $100. Previously, we did an example of Euro-USD, but what if we want to calculate the profit and loss for gold, silver, Brent or crude oil? All we have to do is change the T value in our equation, and T is the value of 1 standard lot. For currencies, it's 100,000 units. But for gold, the standard lot is 100 ounces. For silver, it's 5,000 ounces. And for Brent or crude oil, it's 1,000 barrels. Let's do an example of gold and crude oil to clarify this. Let's say we bought 2 lots of gold at 1300.26 and sold it at 1302.5. And we want to calculate the total profit or loss. Let's plug in the values. As we know, the value for T is 100 ounces for gold. Multiply this by 2, the number of lots, all multiplied by the difference of the selling and buying price, 1302.5 minus 1300.26, and we get a total profit of $448. Let's do another example of crude oil. Say we bought 5 lots of crude oil at 56 and sold it at 56.8, and we want to calculate the total profit or loss. We use the value of T, the standard lot, which is 1,000 barrels, multiply this by 5, the number of lots, all multiplied by the difference between the selling and buying price, 56.8 minus 56, and we get a total profit of $4,000. Forex brokers earn from their clients by charging spreads and commissions. Spread is the difference between the ask and bid price of a currency pair. So if there are lower spreads, there are higher commissions, and if there are lower commissions, there are higher spreads. So either way, brokers will make you pay for trading with them. During trading sessions, spreads tend to widen when volatility is high and liquidity is low, and they become narrower in opposite conditions. There are 3 types of accounts offered by Forex brokers: floating spread, fixed spread, and zero spread accounts. In a floating spread account, the spreads are always changing. They get narrower or wider under different market conditions, and normally these accounts have no commissions. In a fixed spread account, as the name indicates, the spread is fixed. So it's not changing all the time, rather it's always constant. And they also have fixed commissions. So if the ask and bid price have a difference of a fixed spread of 2 pips, as soon as you buy, you lose 2 pips, which becomes your broker's profit. So it's a very carefully crafted system through which Forex brokers earn from their clients. Finally, we come to the zero spread account, in which the spreads are absolutely zero. In other words, the bid price is equal to the ask price. Most people haven't even heard about these accounts because only a very few brokers offer these. The only brokers I know of are Super Forex and FXCL, who offer zero spread accounts, but they charge very high commissions, on average of $20 per lot. Let's do some examples of commissions and spread costs. In our commission equation, K is the round turn commission per lot. So if your broker tells you they have a $3 round turn commission, this means they will charge you $1.5 for buying and $1.5 for selling. So 1.5 plus 1.5 makes $3, which is your round turn commission. L is the number of lots, and let's say if you want to trade 5 lots with a round turn commission of $3 per lot, all we have to do is multiply them both. So 3 times 5 equals a total commission of $15. Let's come to the spread cost equation. S is the spread cost we want to calculate, T is the standard lot, L is the number of lots, and I is the spread or the difference between the ask and bid price. Let's say we want to trade 2 lots of GBP USD, and if we subtract the ask and bid price 1.3069 minus 1.3067, we get a spread of 0.0002 or 2 pips, which is our I value. So the standard lot is 100,000 times the number of lots 2 times the spread 0.0002, and we get the spread cost of $40. This is the amount your broker will earn instantly as soon as you will buy the GBP USD, because if you buy it at 1.3069, you can now sell it at 1.3067. So you've lost 2 pips instantly, which is equivalent to $40. Leverage is the borrowing of money from a broker to open trades. Every broker offers different leverages such as 1 to 100, 1 to 200, 1 to 500, and so on. For all US citizens, a maximum of 1 to 50 leverage is allowed. So this means leverage lets you trade more than you originally have. So with 1 to 100 leverage, you can trade 100 times your original amount. A leverage of 1 to 200 means you can trade 200 times your original amount. Let's do an example for the Euro USD. If your broker offers 1 to 100 leverage and you have $1,000 in your account, this means you can trade 100 times 1,000, that is 100,000 or 1 lot of Euro USD. Now, leverage is a double-edged sword. Either you will win a lot or lose a lot, depending on how you trade. In our example, if we open the trade for 100,000 or one lot, in 10 pips, we will win or lose $100 out of $1,000. On the other hand, if we had traded without leverage or one-to-one leverage, we would just trade 1,000 or 0.01 lot. The profit or loss would be $1 in 10 pips out of $1,000. So leverage can be very risky while trading, and if used carelessly, it can wipe out your account balance very quickly. That's why the Forex market is much riskier than the stock market, as the leverage offered is very high. When you open your MetaTrader platform, look at the bottom of the screen and you will find a Trade tab. When you click on it, you will see 5 variables: balance, equity, margin, free margin, and margin level. All of them are interconnected variables, which means that if one of them changes in value, all of them change. Hence, they are interconnected to each other. These variables and their values will appear in MetaTrader in a tab form such as this. In a few minutes, we will discuss all of these variables in detail. We will look at their exact definitions and how they are calculated. Equity is the total amount left over after subtracting floating profits and losses from the account balance. When you have some trades opened in your account, as the market moves up or down, your floating profits and losses are always changing, and that's why they are called floating. In the equity equation, you add your total cash, Z, to your floating profits, X, and subtract your floating losses, Y, and you get your equity, E. Let's do a quick example. Let's say we have $25,000 cash in our account. We have an open trade on the Euro USD with a profit of $5,000 and another open trade on USD JPY with a loss of $2,500. Our equity is 25,000 plus 5,000 minus 2,500, or a total of $27,500. Margin is the minimum amount of money you need to have in your account to open a trade given a certain leverage. In a moment, we will do an example of margin, but first let's look at its equation and variables. M is the margin we want to calculate, U is the trade size in units, V is the leverage, and R is the exchange rate. Let's say we want to trade 5 lots or 500,000 units of the Euro USD. Your broker offers 1 to 100 leverage and the current exchange rate is 1.1388. Divide 500,000 by 100 and multiply by 1.1388 and you get $5,694. And this is the minimum amount you need to have in your account to open a trade for 5 lots of Euro USD given a leverage of 100. And this minimum amount is your margin. Margin level is just a ratio of equity to margin. It's simply used as a measure of risk. It tells you if your account is in a more or less riskier position. It's expressed as a percentage. If it's below 100, your account is in a more riskier position, and if it's above 100, it's in a less riskier position. In other words, it's just a risk management indicator to let you know how well managed your account is. In the margin equation, N is the margin level, E is the equity, and M is the margin used. Let's do a quick example. Let's say your account equity is $25,000 and you have used a margin of $5,694 to open a trade. Divide 25,000 by 5,694 and multiply by 100 and you get a margin level of 439.06%, which is above the 100 scale. So this means your account is in a less risky position. Free margin is relatively straightforward. It is the equity left in your account after subtracting the margin you have used to open trades. F is the free margin, E is the equity, and M is the margin used. So in our equation, if you take out the margin used from your equity, you get your free margin, or the amount you have in your account to open further trades. Let's do an example. Our equity is $25,000 and we've used a margin of $5,694. Subtract 5,694 from 25,000 and we're left with $19,306, which is the free margin or the amount available to open more trades. When you've opened a trade and the market moves against you, eventually you get a margin call, which is a warning or a notification by your broker to let you know that your equity has fallen below your used margin. At this point, either you can close some of your trades or deposit more money in your account to keep your trades open. Otherwise, after some time, your broker will forcefully close your trades at a certain point of loss. The margin call equation has the following variables: G, which is the point at which you will receive a margin call, A sub G, which is the percentage of margin call, and every broker has their own percentage. M is the margin used. Let's do an example. We have used a margin of $5,694 to open some trades and our broker has a 50% margin call level. We multiply 5,694 by 50 and divide by 100 and we get $2,847. This means when our equity falls to this point, we will receive a margin call. After we've had our warning through a margin call and the market moves even further against us, eventually a stop out level is reached when all or some of your trades start being closed forcefully by your broker. In the stop out equation, O is the point of stop out, A sub O is the percentage of stop out our broker has, and M is the margin we've used. Let's say the stop out level is 20%. And the margin used is $5,694. Multiply 20 by 5,694 and divide by 100 and you get the stop out at $1,138.8. Previously, we had received a margin call at $2,847, and if the market moves even further against us, we will be stopped out when our equity falls to $1,138.8. If you're holding a currency pair for a couple of days, then every day an amount will be added or deducted from your account depending if you have gone long or short, and this amount is called a swap. Basically, it is the interest rate differential of two currencies traded. In a moment, we will do an example to clarify this even further. Every day at 5 p.m. New York time, swaps are calculated and debited in your account. It is 12 a.m. in MetaTrader time format, as MetaTrader time zone is GMT +2. So you can keep a track of swaps according to the New York local time or the MetaTrader platform time. If you go on Market Watch in your MetaTrader platform and right-click on the currency pair you want to trade and then click on specification, scroll down and you will see two columns of swap long and swap short. Let's do an example for trading one lot of Euro USD. Let's say the swap long is 0.56 and swap short is -1.09. This means if you go long, you would earn an equivalent of 0.56 pips, and if you go short, you would lose an equivalent of 1.09 pips. In other words, if you buy and hold one lot for one night, you would earn 0.56 pips. That is a profit of $5.6. On the other hand, if you short and hold one lot for one night, you will lose 1.09 pips. That is a loss of $10.9. On Wednesdays, swaps are tripled to account for the weekends because the Forex market is closed on Saturdays and Sundays. The rest of the 4 working days, they remain the same. So there are a total of 7 swaps in 5 working days, 3 on Wednesday and 4 on the other days. Let's do another example. Let's say we go long on one lot of Euro USD for the whole week. How much profit can we make if we earn a swap of 0.56 pips every day for the whole week? On Monday, we would earn $5.6. On Tuesday, the same. On Wednesday, we will earn 3 times as much. On Thursday, again $5.6. And finally, on Friday, we earned the same. So if we add them up, we would earn $76.3 for the whole week. Looking at this, you might think that maybe you can earn a lot through swaps, but you can also lose more compared to what you're earning due to the volatility of the currency pair. What if you don't want any swaps in your account? Is it possible? The answer is yes. Almost all brokers out there offer swap-free accounts. So if you email your broker and tell them to make your account swap-free, you won't have to pay or earn any interest on the currency pair you're trading. Now we come to the equation used to calculate rollovers or swaps. In our equation, S is the rollover or swap we want to calculate, N are the number of nights we will hold our currency pair, L is the number of lots we want to trade, R is the swap rate, and W is the value per pip for one lot of the currency pair we're trading. Let's do an example to clarify this. Let's say we want to hold 5 lots of the Euro USD for 2 nights at the swap rate of 0.612, which you can also see here. What is the rollover or swap we would earn? Let's input the values into the equation. For one lot of Euro USD, the value for 1 pip movement is $10. So W equals 10. Our number of nights equal 2. Number of lots equal 5. And the swap rate is 0.612. After multiplication, we find out the total swap earned, which is $61.2.